We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We are seeing the effects of our policy actions on demand in the most interest-sensitive sectors of the economy, particularly housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 25 basis points today, continuing the step down from last year's rapid pace of increases.
Feds raise rates 25 basis points, still moving forward. Article from MarketWatch. Feds lift interest rates again, but foresees only a couple more hikes. In its inflation fight, Fed signal it will raise rates in smaller amounts, beginning with Wednesday's 25 basis point rate boost. The Federal Reserve approved a quarter percentage point increase in a key U.S. interest rate and signaled that just a couple more hikes are likely before the central bank takes a breather in its fight against inflation. They then lifted its benchmark short-term rate to a range of 4.5% to 4.75%. The decision followed 6 larger rate hikes in a row, as the Fed stepped up its efforts to squash the first worst bout of inflation in 40 years. Fed Chairman Jerome Powell said, quote, "This inflationary process is underway" at a press conference after the decision, yet he also reiterated the Fed needs to see, quote, "substantially more evidence that price pressures are evaporating." The Fed's entailed public statement seemed to convey a sterner message, repeating its view that ongoing increases were needed to return inflation to their 2% goal over time. Analysts point to a slowing economy and a waning inflation to support the case for the Fed to ease up on the monetary brakes. If it keeps going, they contend the U.S. could slump into a recession. We are in a recession, guys, already. Why do they keep selling us the narrative that we are not in a recession? I digress. Let's continue. The economy has softened. Hiring has slowed for 5 straight months, and hiring in January may have been the weakest in 2 years. A variety of other indicators also point to spreading weakness. The annual rate of inflation, meanwhile, slowed to 6.5% as of December 2022, 40-year high of 9.1% last summer, based on the CPI, Consumer Price Index, excluding always food and energy, guys. So let's get more information and also see the FOMC minutes and when is the next one. Plus, we must see Jerome Powell in action as well. Editor, roll clips. Fair use.
Thank you. Colby Smith with the Financial Times. Given the economic data since the December meeting, is the trajectory for the Fed funds rate in the most recent SEP still the best guidepost for the policy path forward? Or does ongoing now mean more than 2 rate rises now?
So you're right. At the December meeting, we all wrote down our best estimates of what we thought the ultimate level would be, and that's obviously back in December, and the median for that was between 5 and 5.25%. At the March meeting, we're going to update those assessments. We did not update them today. We did, however, continue to say that we believe ongoing rate hikes will be appropriate to attain a sufficiently restrictive stance of policy to bring inflation back down to 2%. We think we've covered a lot of ground, and financial conditions have certainly tightened. And I would say we still think there's work to do there. We haven't made a decision on exactly where that will be. I think we're going to be looking carefully at the incoming data between now and the March meeting and then the May meeting. I don't feel a lot of certainty about where that will be. It could certainly be higher than we're writing down right now. If we come to the view that we need to write down to move rates up beyond what we said in December, we would certainly do that. At the same time, if the data come in the other direction, then we'll make data-dependent decisions at coming meetings, of course.
Just as a quick follow-up, how are you viewing the kind of balance of risk between those 2 options of, the likelihood of maybe falling short of that or going beyond that level?
I guess I would say it this way. I continue to think that it's very difficult to manage the risk of doing too little and finding out in 6 or 12 months that we actually were close but didn't get the job done, and inflation springs back and we have to go back in, and now you really do worry about expectations getting unanchored and that kind of thing. This is a very difficult risk to manage, whereas Of course, we have no incentive and no desire to over-tighten, but if we feel like we've gone too far, we can certainly, and inflation is coming down faster than we expect, then we have tools that would work on that. So I do think that in this situation where we have still the highest inflation in 40 years, the job is not fully done. As I started to mention earlier, we have a sector that represents 56% of the core inflation index where we don't see disinflation yet. So we don't see it. It's not happening yet. Inflation in core services ex housing is still running at 4% on a 6 and 12-month basis. So there's nothing happening there. In the other two sectors, representing less than 50%, you actually, I think, now have a story that is credible, that's coming together. Although you don't actually see disinflation yet in housing services, but it's in the pipeline, right? So for the third sector, we don't see anything here. So I think it would be premature, it would be very premature to declare victory or to think that we've really got this. We need to see, our goal, of course, is to bring inflation down. And how do we get that done? There are many, many factors driving inflation in that sector, and they should be coming into play to have inflation, the disinflationary process, begin in that sector. But so far, we don't see that. And I think until we do, we see ourselves as having a lot of work left to do.
It's remarkable, the ups and downs, because Jerome Powell's been like this since the beginning of the tightening cycle. He does not vary at all. Nonetheless, the markets do. Federal Reserve Chair Jerome Powell spoke at the Economic Club of Washington, D.C., giving investors new insight on the central bank's path to monetary tightening. Jen Schomburger has the details for us. Jen, it is fun to watch the markets rise and fall as Jerome Powell stays relatively level.
Hi, Dave. It can be entertaining. Fed Chair Powell doubling down this afternoon on the Fed's commitment to ongoing rate hikes, suggesting that Friday's strong jobs report would not change the Fed's approach to future rate increases. Speaking in an interview with David Rubenstein at the Economic Club of Washington, D.C., Powell said the strong job market shows why it will take a, quote, significant period of time to get inflation down, which will require more rate hikes. Take a listen.
We have a significant road ahead to get inflation down to 2%. And I think there's been an expectation that it'll go away quickly and painlessly. And I don't think that's at all guaranteed. That's not the base case. The base case is for me, is that it will take some time, and we'll have to do more rate increases, and then we'll have to look around and see whether we've done enough.
Hey guys, it's Jose, your regular Joe Blow again, keeping an eye out and my ears open to 25 basis points, a lot less than we anticipated. Even the BOE and the ECB raised 50 basis points on the other side of the pond. Guys, stay vigilant and stay prepared. I am not buying yet. I will never tell you what to do, but do your own research, and if opportunity floats your way, at least know what you're buying. Okay? Let's see what comes out of this moving forward. Thank you, thank you, thank you, thank you. I really appreciate each and every one of you guys. God bless all of you for giving me your time to do my best to bring you the best and also room to grow. See you on the next one. Stay free.
It ain't hard to tell. I excel, then prevail.